The wheel is the most recommended option strategy on the internet, and for once the premium is not the problem. I ran it 10,000 times over 30 years. The options made money, $1.64 million, net of everything paid back. The idle cash earned another $2.92 million in interest. And the strategy still finished $6.4 million behind a portfolio that bought the index and did nothing. That is where this video goes. And I should tell you up front, I very nearly published the exact opposite answer. Two portfolios. Both start at $1 million. Both run 30 years. Neither takes a withdrawal. Portfolio A buys the index and does nothing. Portfolio B runs the wheel. It starts in cash. Every month it writes a 1-month, 30 delta cash secured put on the whole balance, fully collateralized, no leverage, ever. The idle cash earns 3.5%. If the put finishes in the money, the shares are assigned at the strike, and from then on it writes a 30 delta covered call every month until the shares are called away. Then it is back in cash, and it starts again. Both portfolios see the exact same market, 10,000 times over. Same crashes, same rallies, in the same order. So anything that differs between them was caused by the options and nothing else. The market itself is real. 25 years of actual SPY daily returns, resampled in blocks, so volatility still arrives in clusters the way it does in life. Before any of the results, the assumption that decides all of them. Option prices. If you price the options wrong, then nothing downstream means anything. And this study is more exposed to that than most because it sells both wings. It sells puts and it sells calls. My engine had one skew number, one figure describing how implied volatility changes as you move away from the money, applied to both sides. And that number had been fitted on the call side for an earlier study that only ever sold calls, so I measured it. Real option chains from SIBO, 30 days to expiry, both wings, fitted separately. The put wing came back at minus 0.955, the call wing at minus 0.454. The real asymmetry is 2.1 times, and I had been pricing both legs off the call side number. Puts are expensive because everyone wants crash protection. Out-of-the-money calls are cheap because half the retail internet is selling them. When I put the measured numbers in, the answer to this study reversed. Before that, the wheel looked like it was winning. One number for both wings is the single easiest way to make this strategy look profitable. I know that because it is the mistake I was making. So here is the part I did not expect, and it is what makes the wheel different from a plain covered call. Over 30 years, the wheel collected a median of $13.65 million in premium. It handed back $11.81 million when options finished in the money. The net contribution from the option program was $1.64 million. Positive. Those are medians of 3 different distributions, so they will not subtract to each other exactly. Each one is the median of its own 10,000 paths. On top of that, sitting in cash 2/3 of the time earned $2.92 million in interest at 3.5%. So the strategy generated something like $4.5 million of genuine income on a portfolio that started at $1 million. None of that is an accounting trick. The premium is real. The skew was measured, not assumed. The interest is money in the account. And the wheel finished $6.4 million behind a portfolio that did nothing. Buy and hold ended at a median of $17.2 million. The wheel ended at 10.5, measured properly, path by path. Each wheel run against its own twin. The wheel came up $6.4 million short, 1.81 percentage points a year, compounded over 30 years. It finished ahead of buy and hold on 16.1% of paths, not half, roughly 1 in 6. And the reason is one number. The wheel was in the market 33% of the time. For 2/3 of a 30-year bull market, this portfolio was sitting in cash at 3.5%, waiting to be assigned. Equity returned nearly 10% a year over the same period. The wheel spent 2/3 of its life on the wrong side of a 6-point gap, and $4.5 million of premium and interest did not come close to covering it. The wheel has 3 moving parts: sell puts, take assignment, sell calls. The internet argues endlessly about the middle one. Should you take assignment, roll the put out and down? close at 50% and resell, I can bracket that entire argument without modeling a single management rule. Every intramonth decision works through one channel and only one. It changes how much of the time you are holding shares rather than cash. Rolling a put to avoid assignment means more time in cash. Closing a call early means more time in shares. So I ran two configurations that never transition at all. One permanently in shares, one permanently in cash. Those two bracket everything any management rule could do. 0% in the market. A pure put writing program never assigned, minus 2.66% a year. 33% in the market. The wheel, minus 1.81. 100% in the market. A covered call, never called away, minus 0.33. Time in the market is the whole story. The rows are perfectly ordered and nothing about assignment mechanics or strike selection or role discipline appears anywhere in that ranking, which means the debate is about the wrong step. And it means a disciplined roller, someone who never takes assignment, which is what Manage Your Winners actually approximates, is not fixing this strategy. They are walking toward the worst row on that list. The obvious objection is that 30 delta is the wrong strike. Sell closer, collect more premium, sell further out, get assigned less often. No. The wheel loses at every strike I tested. Minus 2.18% a year at 16 delta. Minus 1.81 at 30. Minus 2.25 at 45. 30 delta happens to be the least bad of the three, which is mildly reassuring for the people already doing it, and rescues nothing. Far out of the money puts collect too little premium to pay for sitting in cash. Closer to the money puts collect more and get assigned into a falling market more often. There is no strike that fixes a structural cash drag. There is one obvious way this could all be an artifact. Both engines price options at or near fair value against their own processes. Real option sellers get paid more than fair. That gap is the variance risk premium, and it is the entire reason selling options is a business at all. So I measured it. Over 20 years, at the money implied volatility averaged 16.67% against 15.56% of volatility that actually showed up. 1.12 volatility points. Then I reran every regime paying the seller nothing, paying the measured amount, and paying generous multiples of it. The premium is not what decides this. Paying the real 1.12 points moves the strong bull result from minus 32.6 to minus 29.4. 3 points on a 30-point loss. Every regime improves by about the same 2 to 3 points per volatility point. It is a level shift, not a rescue. To break even in a strong bull, you would need well beyond 3 points of premium, and 3 points is already nearly triple what the market actually pays. One threshold does get crossed, and it is worth knowing. In typical and choppy markets, a wheel paid 2 points is roughly break even, and at 3 points it edges ahead. So in ordinary conditions, richly priced options make the wheel a wash. It is specifically rising markets where no realistic premium saves it. I would be doing the thing I criticize if I stopped there. The wheel's median worst drawdown was 32% against 42% for buy and hold, and the pure put writing program, the worst performer on wealth of anything I ran, had the best drawdown of all at 24%. That is not nothing. A 42% decline is where real people abandon the plan and sell at the bottom. A 32% decline is unpleasant and survivable. So the honest description is not that the wheel is an income strategy, and it is not that the wheel is bad. The wheel is insurance. You pay for it in bull markets and you collect in bear markets. And over the last 25 years, there were far more of the former, which changes every question worth asking about it. Not how much premium can I collect. The premium is real, and it is beside the point. The questions are, how much of a rising market am I willing to give up, and do I actually believe I will be in the regime where this pays? And if you want the version of this that keeps the protection without the bill, the bracket points straight at it, and it is the one nobody advocates. Stop going back to cash. Every number in this video is on the lab page linked in the description. Change the skew, change the delta, change the cash rate, and watch the answer move. If a parameter is doing the work, you should be able to see it do the work. This is model-based research, not investment advice.